Most option traders make money for months and then lose 20 to 40% in one correction. That was me. But the problem wasn't my strategy, it was how I allocated risk. Trading many tickers does not reduce risk when they all move together. I'll show you the risk framework I use to stay consistent in all market regimes. I've traded through multiple corrections since 2018 without major losses. In this video, I'll break down a typical trader's ticking time bomb portfolio, how to fix it, and walk through a few live examples. So most option traders have a portfolio that looks something like this. Even beginners know not to trade only one or two stocks. They know the importance of diversification. So they would have a little bit in tech, like Microsoft. They'll have some in consumer products like Starbucks, and then they'll have some real estate like in BlackRock. And of course, a mixed portfolio of stocks like this is better than one or two stocks because that's how people blow up when the market crash. But this is not the way how professional traders diversify risk and manage their portfolios. So here's the problem with that kind of portfolio. Although it is diversified in terms of the companies that the trader has positions in, it's not truly diversifying your risk. The reason for that is because the positions in that portfolio behave extremely similar to the SPY. If the market crashes, probably all of your positions will also turn red. So this is not a diversification strategy that professional traders use. This is still putting all your eggs in one basket. So if you guys were trading back when COVID-19 hit back in March 2020, you guys probably remember it. This is a picture from FinWiz. I took a screenshot back then during the market crash. So as you can see here, it doesn't matter what kind of stocks you're holding. It can be good stocks, it can be bad stocks, but across the board, all sectors, technology, service, basic materials, big caps, a lot of stocks that are considered safe and recession proof, such as Costco, Walmart, still turned very red, and those positions still died and probably hit your stop loss very quickly. Most option traders that focused only on equities had their position turn red that day. So if we just trade stocks, it is not a good enough risk management strategy, portfolio as a whole. So how can we prevent our whole portfolio from turning red and going into a massive drawdown during the next market correction? How can we fix this problem? Professional traders spread out the risk by trading instruments that will not all crash at the same time. This alone will reduce large drawdowns. And what I mean by that is we cannot just be trading equities. We already saw what happens if your whole portfolio is full of equities. What we can do is trade various instruments across various asset classes that has low correlation to each other. Let's talk about what high correlation means. I have a picture here from Tasty Trade. In most platforms, you can add a metric to your watch list called the beta correlation. In layman's terms, beta means how much the price is expected to move relative to the SPY. So if we look at the Qs right here, it's 1.18. What that means is when the SPY moves 1% up or down, it is expected that the Qs will move 1.18% up or down based on historical stats. So anything close to 1.0 beta is basically trading the same instruments. We can see here all these popular equity instruments, the Qs, the IWM, and the SPY, their beta is essentially 1. So they behave and move the same way as each other. And this is a problem. Let me give you an example. So if you're a disciplined trader and you have a 2% stop loss, a 2% max loss per position, during a market crash, all 3 of your positions will hit max loss and all of them will have 2% loss. And a lot of beginner traders will think they diversified because they traded 3 different things. But in reality, when you stop out, you're going to have a 6% loss right there. And that is way more than your ideal 2% loss. This is one reason people have big rips in their account, even when they follow their max loss and stop loss rules. The problem is they didn't include asset class diversification in their trading plan. So let's talk about what is low correlation. Right here I have some bonds, ZB, I have oil, CL, and I have gold, GC. We can see that the beta factor here is relatively low. I would consider anything less than 0.3 as low correlation, and that is the ideal number. I would say 0.5 is the minimum amount of beta for us to consider it to be a low correlation asset. CL here, oil, has a correlation of 0.22. So what that means is when the SPY moves up or down 1%, oil usually only moves 0.22% up or down. So that essentially already tells us they're not related. They don't behave in the same way. It's mainly driven by geopolitics like wars, weather, supply and demand, and logistical reasons and inflation. So if we have positions in the bonds, the oil, and gold, we are fairly safe and diversified away from our equity positions. These 3 positions will not move or behave like the SPY, and that is exactly what we want. These are a few examples of instruments that are ideal for portfolio diversification. So let me show you what I like to trade. I like to have one position in the equity markets. I like the ES because it is the most popular futures out there. I also like to have one bond position, the 30-year treasury. I also like to have one metal position. I like the gold. I will also have one energy sector position, and I like to have oil. And the forex futures, I like to have positions in all 4 of the most popular pairs. So the euros, Aussie, the yen, and the pounds. The correlation between the various pairs are actually pretty low too. So it's okay to have position in all of them. And I also like to have one position in livestock, such as cattle or hogs. Now, regarding the equity sector, I prefer to trade sector ETFs. Not all of them have low beta, so you gotta check on your platform. If you want to play stocks, that's fine too. I have stock positions, but we need to be mindful of our position sizing, as a lot of them have very high beta and we don't want to have too much exposure to the equities. Your ES position and your stock positions will probably all turn red when the market corrects, as they are highly correlated. So I'm gonna go over some examples and let's look at some correlation charts. Right now I have ES open and that's the blue line. Let's overlay Nasdaq over it. ES is the white line and Nasdaq is the blue line. You can see that it's basically the same thing. If you just imagine moving up this white line and moving it up a little bit, it will stack on top of each other. The highs are almost the same, the lows are the same. You can see it moves up and down the exact same way almost. That's why their beta correlation was 1.18, very close to 1. The IWM, very similar, right? It's basically a mirror image. Now, if we look at something else, like for example, crude oil, we remember the beta was about 0.22. It is very obvious that the blue and white lines are very erratic. You cannot really see an obvious pattern here. When the SPY drops, it does not mean the oil also drops. For example, here, even if it drops, it didn't drop as hard. That's why the beta correlation is 0.22. When we look at natural gas, I don't see any patterns at all. They don't look similar in any way, shape, or form. Copper, totally different. The metal market is not the equity market. People still need copper when the stock market crashes. So, for example, copper price is dictated by supply and demand issues, logistical issues. Another one here, this is the hog futures, pig prices. So you can already use some common sense and you can tell. If the stock market crashes, the economy is not good. It does not mean pork will get more expensive or cheaper. Hog prices are affected by various different factors such as weather, diseases, supply, logistical issues. The bond market, here we can see it is very obvious that it does not behave in the same way. So that's why I like trading this. The market can crash and the bonds didn't really move either. So that's what we like. Let's take a look at the forex pairs. The market went up a lot for the past few years. The currency prices, it was in a slight downtrend. But in comparison, like it barely even moved. So that's why I like trading it. Another forex pair, the British pounds, the yen, the euros, you can see is relatively flat and it's perfect for a very specific strategy that I always trade. And last but not least, we have gold. I really like trading gold because it is very liquid, it is very popular to trade, and it has very low correlation to the SPY. I'm gonna zoom out right here a little bit more, and we can see that it's not too obvious if there's any patterns of them behaving the same way. If we look at here, 2012 to 2020, the ES was on a bull run for the past 8 years. Gold actually dropped a little bit and was flat the whole time. So I like how it's not really related and it does not move the same way. Hence, it is a great instrument to add to our portfolio to trade. I hope this gives you a good introduction to the world of diversification, and now you know that it's not just about trading various stocks to diversify. We can also use various different asset classes to diversify our risk. Trade small, trade safe.